is Motley Fool Answers. I'm Alison Southwick, and I'm all alone. Well, Rick's behind the glass, but bro is off. So this week, I'm sending you to our member event in Denver, where Matt Argersinger and Aaron Bush spoke to a group of investors about investing in IPOs and some IPOs to watch. All that and, well, only that, on this week's episode of Motley Fool Answers. 2018 is shaping up to be the biggest year for IPOs in nearly 2 decades, which means there are even more opportunities to invest in the next big thing. So let's head out to our member event in Denver, where Matt Argersinger and Aaron Bush spoke in front of a bunch of fools about some of the more recent IPOs they are excited about, along with their general advice on how to invest in a company that has recently gone public.
The market cycle, the economic cycle can have a tremendous influence on IPOs. We saw the tremendous number of IPOs, the record IPOs in 1999, and really good year in 2000 as well. But then look at 2001 to 2003, really fell off the map. No companies were, given the market volatility, given the mild recession we had, companies were just really hesitant to go public. All of a sudden, there was much more scrutiny on companies' financials. Investors started to look more at profits rather than great stories and priced eyeballs and other crazy wonky valuations that came about during the late 90s and early 2000s. And it kind of fell off. But as the economy improved, 2004, 2005 through 2007, it became another decent time for IPOs. But again, here we go, 2008, 2009, financial crash, bad economic cycle, IPOs fell off the map. And now we've been in this weird period really since 2010 where IPOs have come back. But as you can tell, other than maybe 2014, it's been a relatively, mild time for new public companies. And certainly the last couple of years have been relatively poor. This year, it's been a little bit of a sea change. There actually have been quite a number of IPOs. In fact, when I did this slide about a week ago, there have been 194 IPOs so far of at least $10 million. And that already exceeds the 2017 total. So year to date through roughly October 10th, we're already vastly exceeding the number of IPOs that we saw last year. In fact, and we're on target this year for these companies to raise $75 billion, which actually would be the second most since 2000. So in terms of this century, 2018 could be the largest year for IPO value since 2000. So what Aaron and I did, and we did a similar thing back in the summer, is we looked at companies that have come public this year. I think we did 6. David Kretzmann was with us. We did 6 IPOs back in the summer. This time we looked at 6 again, one of which is a repeat. But we have 5 brand new companies that recently came public that we're looking at. And so without further ado, let's go to our first one, which is Bloom Energy. And before I talk about that company, I'll just say, Dan Boyd, if you wouldn't mind playing, we have about a 5-minute video that kind of goes into Bloom Energy, the CEO, and I think it'll be a good job of explaining what this company's about.
My name is K.R. Sridhar. I'm the founder and CEO of Bloom Energy. The mission of Bloom Energy is to make sure that everybody on the planet has access to energy. When I was working the Mars missions and I was working for NASA, I was trying to figure out how to produce breathing air, water, heat, electricity, so one day humans can live on Mars. It dawned on me watching 50 million people coming out of poverty every single year on Earth. All these people want the same things that we all have. We got an immediate problem on planet Earth. What Bloom does, it produces electricity on site for customers in a reliable, affordable, and sustainable manner. On the outside of the Bloom box, natural gas, the gas that comes into your home for cooking, for heating, the same gas goes in, and out comes electricity that comes into your main switch and gives you the electricity for the building. Inside of these Bloom box, you have these little wafers called fuel cells. One fuel cell like this can produce enough power for one light bulb by taking fuel on one side, air on the other side, and producing electricity with no flame, with no combustion. So very little pollution, very high efficiency, no in-between steps, great power. Stack them together and build a brick. This cube, 4 inch by 4 inch by 4 inch, is enough to produce power for one average US household 24/7, all day long, all year long. Now, put them together in a big farm. That can power a data center or a huge community We are doing all that right now.
You go upstairs.
There's so many different definitions of entrepreneurship, but the favorite one that I've heard is entrepreneur is somebody who knows how to do more than anybody thinks is possible with less than anybody thinks is needed and faster than anybody thinks is possible. What motivates me are big ideas. I wake up in the morning and I'm ready to go to work if and when I know that whatever I'm going to be doing is going to have a huge impact if I'm successful. My son, when he was 9 years old, said, why not put Bloom Energy as the name? And I asked him, why Bloom? He said, because it's not geeky sounding. And most importantly, the reason you're working so hard is you want economies to bloom. You want lives to bloom. You want the planet to be sustainable where flowers will bloom. I had no reason to believe why we cannot be the revolutionary change for electricity.
By the way, this video was from a few years ago, and the company, has obviously, Bloom Energy's gotten a lot bigger since then, and of course they just went public this summer. And there's a lot to love about this company, and you kind of got a hint from that. But the founder, K.R. Sridhar, he came up with this solution, and they've had a lot of initial success, especially in kind of primary areas like data centers, healthcare, microgrids. For some of the companies like that we were up there, Walmart, eBay, what they serve as really sustainable, low energy, very efficient backup systems for a lot of what they do. And having that kind of access to energy that's off the grid. So primarily it employs either natural gas or biogas, very low amounts of natural gas and biogas to create a lot of electricity. It makes it so that really you have 24/7 sustainable, but also backup energy in case something happens with the grid, or if there's some kind of electrical shock. So lot to like. I'll point out one statistic I really like is that the average Bloom box, it's 125 times more space efficient than solar. So one of those, if you saw one of those boxes, kind of the big ones that were outside, you would need essentially 125 big solar panels to create the amount of energy that's coming from one Bloom box using a small amount of natural gas with very low emissions from that. And you can see some of the largest customers, AT&T, Equinix, which is one of the largest data center companies in the world, if not the largest. Home Depot, Southern Company is a big partner of theirs, deploying Bloom boxes really all over the country with their footprint. So an exciting IPO, one that I'm kind of excited to watch and see where it goes over the next several years. And we'll go to the next one.
Let's talk about Eventbrite. So how many of you have used Eventbrite before? All right, that's what I thought. Yeah, so you all know what Eventbrite is. For those of you who don't, think about events as a spectrum. On one side, you have, small family, friend gatherings. You don't really need a platform for that. So far, my mom hasn't asked me to buy a ticket for Thanksgiving dinner yet. So that's on one end of the spectrum. And on the other end of the spectrum are, the giant sporting events and concerts, where the venues have a big contract with a ticketing company. But there's a huge middle zone in between there, for things like seminars, things like classes, things like wellness, activities, fundraisers, all sorts of events that are just in that perfect middle zone. And that is where Eventbrite focuses. And so the platform is really interesting. It's modular so that people who are making events, they can be flexible in how that works on their platform. And it has features such as registration, such as ticket purchasing. It can tie in with all sorts of third parties like Facebook and HubSpot, Salesforce if you need. And they really have taken really the top dog status in this industry so far. And just for some stats, just to understand how big this company has become, in terms of its presence and events. Over the last fiscal year, their platform served over 700,000 event creators for over 3 million events in over 170 countries. and they issued 203 million tickets over the past year, which is a lot of tickets. Not all of those are paid tickets, but it's still a lot of tickets. And their economic model is pretty simple. They take a base fee and often a small percentage of the ticket price. And so as more people use Eventbrite, the more money Eventbrite makes. And those sound like really big numbers, and they are, but the opportunity is even bigger than that. So they estimate that in their top 12 markets, there are about 3 billion tickets that they can go after. And so 200 million, 3 billion, that's still a pretty substantial jump. And over 1 billion of those 3 billion tickets are paid. And that is where they would make their money. And so just looking at, I pointed out a couple metrics that are really important here, just thinking about how their economics work. The first one is just the growth in paid tickets, because that's where the money is at. Over the past year, they've grown 59%. So they're growing super quickly. And then they have a super high retention rate too. And this isn't exactly a customer retention rate. This is closer to a dollar retention rate. But it's really important that those who use Eventbrite is able to keep them in their system. And so far, so good. But those are the two metrics I would pay the most attention to going forward. And Eventbrite is the top dog, which we like to see, especially for rule breaker style companies. That's the first trait of being a rule breaker, being the top dog and first mover in an important emerging industry. And I just called out a couple advantages they have. One is the brand. As we saw, pretty much everybody raised their hand for having used Eventbrite. And so if you think about it, if now you are to go and create your own event, there's a good chance you're going to use what you have seen as a consumer, and that's a huge advantage that plays in their favor. Also, ticketing is a pretty big industry, and there are a lot of companies out there trying to get in different verticals and getting to different countries, just different parts of the market. But Eventbrite has the potential to roll up a lot of those players. In fact, over the past couple of years or so, they've actually acquired 7 ticketing companies. One of those is Ticketfly, which some of you might recognize. Pandora acquired Ticketfly for a pretty absurd amount of money and sold it to Eventbrite for about half the price that they purchased it for. And as an example, that gives them deeper footing in music. And so how they view rolling up and moving into other countries is smart, I think. And this company produces free cash flow when others are still trying to struggle to grow into their certain domains. The founders are Julia Hartz and Kevin Hartz. It's a couple, not bad. Julia is the CEO, Kevin is the chairman. Fun fact, Kevin was also the founder of a past stock advisor recommendation, Zoom, which was later acquired by PayPal. So I'm impressed what these founders have been able to do.
And Aaron, you mentioned music and competing ticketing companies. Well, so I'm sure a lot of people sitting here probably own Live Nation, or at least have followed Live Nation a little bit. What, if I'm thinking about Eventbrite, what are the key distinctions between Eventbrite's business and Live Nation's business? Yeah,
so as I was kind of talking about the spectrum, Eventbrite is right in the middle, so more middle-sized events. Live Nation is going to be going after blockbuster concerts, and so they have contracts with the venues that Eventbrite would never even touch that. So they really are serving completely different types of events, and I don't think Eventbrite might go into some music more, but I don't think they'll clash too much.
Great. So our third one is a company we actually talked about in our last one, and that's DocuSign. I'm sure everyone in the room knows DocuSign and has probably used DocuSign. Actually, raise your hand if you've used DocuSign in the last year. Yeah, pretty much everyone in the room. It has become, I think, and well, it says right there, the world's #1 e-signature solution. But really, I think it's a brand that all of us are becoming more familiar with. If we're buying a house, buying a car, refinancing our house, entering into a contract, it's really just become a very ubiquitous platform and a very successful platform. Just came public back in April. I like the way the founders and the executives have sort of framed the mission of DocuSign, which is transforming the foundational element of business, the agreement. If you think about how legal agreements exchanges, contracts happen between corporations or individuals over over decades. The amount of paperwork, the amount of third-party involvement, the amount of record keeping. Think about fax machines just blowing up every day. I mean, the amount of paper out there that was needed to actually sign and have official agreements come into effect. DocuSign has just really totally revolutionized that whole process. Not only taken away, of course, all the paperwork that used to be required, but just made it so much more efficient. If you think about just the idea of when buying a house or putting an offer on a house, the amount of pages of documents you're going through, and if you've used DocuSign, you can not just fly. I mean, you shouldn't, but you just fly through that if you want. You hit next, you sign, you initial. You eventually, it takes maybe 5 minutes to initial 80 pages worth of documents, and it's incredible. Tremendous brand awareness. I think all of us, as we know, we've used it. We know the name DocuSign. Right at this moment, they have 425,000 customers, and their customers. When I say customer, it's not just us. If they counted us, we'd be millions. We're just users. But customers who use DocuSign to create documents, official documents, to get two parties to sign documents and have that kind of capability. You're talking anything from a single person office, small business, maybe a real estate broker, up to, of course, major investment banks, Fortune 500 companies that have used the DocuSign platform to execute contracts. It's a big customer base, growing crazy. Up until through last quarter, 650 million cumulative transactions have been done using DocuSign, and I believe that's over the last 15 years since DocuSign's really been around. Their primary business is subscription. Their customers on various tiers are subscribing to use DocuSign. They pay kind of to the extent they're using the platform, and that revenue was up 35% year over year. And I'd say that's certainly the number you probably want to watch, the key metric for DocuSign going forward. The founder is Thomas Gonzer, and he was a lot more involved with the business early on. He's still on the board, though he's since moved on. He's kind of gotten into the venture capital business himself. He's no longer an executive at DocuSign, so it doesn't really have the close founder touch that it used to have. But I'm really impressed with the executive team. If you look at the CEO, whose name now escapes me, he's got a 98% approval rating on Glassdoor. The company professes to have a really nice, positive working culture where people feel challenged, respected, and have fun working. So one of those businesses, and it is a recent Rule Breakers recommendation, I think, as of a few months ago. Mm-hmm. So that's one that certainly has got onto the scorecard somewhere. So certainly check out that write-up. But this is one, we're all familiar with. You might want to follow a little more over the next several years.
Two numbers stand out to me on this slide. One is 425,000 customers. That's huge. If you follow any other, software companies, they're like a tenth of that generally. And so, they might not make as much money off of each of these customers, but just the fact that they have that many is a huge testament to their brand. So impressive. The other number, the recent price. You could tell we put this together maybe a couple weeks ago because the recent price is like $40 now.
Right. So there you go.
But that's interesting.
You get it a big discount, but yeah, it's certainly been a volatile time for a lot of companies just like this. So get it at a cheaper price if you can. Company number 4.
Zuora. I know this is in one other full service, I believe. How many of you are Zuora shareholders? Okay, cool. Good. A good number. So this is a cloud-based provider of subscription software. So they're the software that, powers other businesses, startups that want to create subscription businesses, or big legacy companies that want to shift their business model over to subscriptions. And appropriately, they sell their business on a subscription basis too. And if you think about it, this is a trend that is probably one of the most powerful technology trends that's out there. As we enter a subscription economy, people are, buying fewer things, but going more the subscription path for a wide variety of goods and services. So they're in a really good spot there. They have 2 flagship products, Zuora Billing and Zuora RevPro. Zuora Billing really was their main flagship product for many years. They acquired another company that let RevPro also be a flagship service. The billing automates a lot of just, when you think about subscriptions, a lot of those like tasks that go into managing that. RevPro is a revenue recognition product, so it deals with compliance and things like that. This is interesting to me because most software companies have one flagship product, but by having two, it gives them two ways to attract customers. So naturally, they attract more customers than they would have if they only had one. And they're doing a really good job so far. So those two flagship products are selling really well, and they continue to launch other products around like how to maximize customer lifetime value and other various aspects of subscription, eliminating churn. And as I mentioned, they're doing really well. So they're seeing pretty impressive growth that I think is sustainable just because this trend is so sustainable. Over the past year, they've grown revenue 47%. That's naturally going to fall down because they've made acquisitions and such. But I imagine it's one of those companies, when Tom said he looks for companies that can keep double-digit growth rates for many, many years. I think just because of the trend that this company is riding and how ahead they are of other competitors, I feel like they have a good chance of being like that too. If you look at, their top customers over $100,000, they've seen 28% growth over the past year. But perhaps the statistic that's more interesting than that, since their 2016 cohort, I believe, of those over $100,000 customers, they've only lost one. So pretty incredible customer retention rates, which says a lot about what they do. And their dollar retention rate is pretty positive, 112%, shows that once people get into the ecosystem, they continue to expand with their relationship with Zuora, expanding into other revenue lines, or often a business will just use Zuora for one service that they're trying out, then roll it out across the entire company. The founder is Teen Zo, I think that's how you pronounce it. He was the chief strategy officer and chief marketing officer of Salesforce for a few years. So he has a really impressive background. He owns about 7% of the company. Also, Mark Benioff, who's the founder and CEO of Salesforce, owns 3% of Zuora. So that's a pretty solid sign of admiration, if you ask me.
Nice. And yeah, I think if I'm not mistaken, I think Zuora's become a recommendation of Motley Fool Pro. And as all of you, if you know Jeff and his teams, they love to look at sort of these companies where there's lots of recurring revenue, very low capital costs. And this kind of fits perfectly into that strategy, for sure. All right. I think we're going with the fifth company. I think this is another one where you guys are going to be pretty familiar with the brand, probably even used it at some point over the years, but SurveyMonkey. And the official corporate name is SVMK, but they just went public less than a month ago. And, as it says, the world's leading online survey brand, they kind of call themselves a pioneer in people-powered data, which they kind of say is the merging of big data and also personal data, personal interactive data that human beings, not robots or social network scrapers, but people are really actively inputting their data into SurveyMonkey surveys. That data is collected, stored, analyzed, to the 13,000th degree, and therefore SurveyMonkey enables businesses and their customers to make smarter decisions about products, about their, maybe about hiring, recruiting, and things like that. So the nice thing about SurveyMonkey is its software really integrates seamlessly with Google applications, Microsoft, Salesforce, Slack, and so SurveyMonkey can just really sit right on top of those applications and platforms and really work seamlessly with technologies and people are interfacing with those tools. They have 16 million active users in 190 countries. Pretty impressive number. Much less are paying, but they have 600,000 paying users. Now again, that scales all the way from one person, paying for a premium subscription to SurveyMonkey to Fortune 500 companies. And mentioning Fortune 500 companies, they have organizational level agreements with 71 Fortune 500 companies, which means that those companies use SurveyMonkey's platform for some pretty rigorous survey applications, either internally or externally with customers. And those are ongoing subscription-based transactions. It's a relatively small company, $13.75 recent price. I would say, as a lot of these IPOs, the IPO price was a lot higher. So this is one where that's come down quite a bit from its IPO price, but a market cap of less than $2 billion. The founder, Ryan Finley, He is interestingly not the CEO or chairman or anyway. He's the VP of design, which sometimes tends to happen with a lot of these companies. You have an entrepreneur who started the company, designed it, and said like, I love just being on the design end, on the operating end. I don't want to be an executive or a manager, and so that's him. He is the second largest shareholder of SurveyMonkey. Does anyone know who the largest shareholder of SurveyMonkey is? It's kind of an interesting story. Sheryl Sandberg, that's right. And it's kind of a sad story. The reason she's also the chairman, I take that back. I'm not sure if she's the chairman, but she sits on the board. She's the largest shareholder of SurveyMonkey because her husband was Dave Goldberg, who was the CEO of SurveyMonkey, and he owned an 8% position in SurveyMonkey, and he tragically died a few years ago from cardiac arrest. And she inherited, as his wife, she inherited his stake in SurveyMonkey. So anyway, just an interesting connection, although a bit tragic.
Naive question for you.
Yes, I think I know what it might be.
Why would I use SurveyMonkey if I could just use Google Forms?
Good question. I think with this, it kind of depends on stickiness of the platform, familiarity with the app, how much data I have, and as my organization or as an individual in the SurveyMonkey system, and maybe I don't want to move away from that, and maybe I have a sense, I'm not really a user of SurveyMonkey, but I have a sense they're probably a little more efficient and scalable when it comes to gathering data as opposed to Google Forms, but could be wrong. The question I thought Aaron was going to ask was the fact that one of the reasons SurveyMonkey sold off recently pretty sharply is because there's a company called Qualtrics, which is, if I'm pronouncing that rightly, they just filed to go public. They are a competing survey application. Certainly less brand recognition, but bigger company growing at about a little more than twice the rate that SurveyMonkey is growing. So I don't know a lot about Qualtrics, but
and they're profitable.
And they're profitable. Big deal. So and they're likely to come public within the next 30 days. So if you're interested in SurveyMonkey, you might want to check out Qualtrics too, just in case. Okay, final company, final 6. Here we go. Aaron,
Elastic. So I've been really interested in looking into this company. It probably just looking at it as like an interesting company, it probably intrigues me the most out of all of these. So Elastic is an enterprise search company. So if you think about search, you probably think of Google just typing text into a text box, pressing enter, and a bunch of links or information pops up for you. But as it turns out, search is much more than just typing text into a text box. So if you think about, you can search on apps, you can search on websites, you can search into enterprise data. There's application performance monitoring, business analytics, security analytics, and search plays a role in all of those different things. So what they're trying to solve in being an enterprise search company touches a lot of different factors that a lot of enterprises have to deal with. And so if you're still confused by what that means, let me just give a few examples for you. So how many of you have taken an Uber on your trip here? A few? So if you think about it, when you are taking an Uber, you are searching for a driver, and the driver is searching for a rider. Elastic helps power that search. I won't ask this one, but Tinder is another example. When you're swiping, the algorithm that decides who you match with, part of that is powered by Elastic. Adobe.
I think you should totally ask though. How many people have used Tinder in the last? Oh, okay.
Solid.
I should have. Yeah, I didn't know what the right time frame was going to be, so I should have asked. Sorry, Aaron.
So Adobe, Elastic helps power if you're searching for the right photos or fonts or textures. Adobe uses Elastic Sprint in a bit of a different way. Elastic helps them log billions of events per day to track website performance and network outages. Search plays a role there. SoftBank uses Elastic to monitor thousands of its servers to make sure that everything is running smoothly and to alert those who work with the servers to help them catch any potential problems that rise up. Facebook When you search on Facebook, Elastic plays a role. If you search on a ton of different online websites and it suggests a product to you based on your search or what you're looking at, there's a good chance that Elastic is behind that too. So search is permeating a lot of different things. Elastic is behind a lot of different things, a lot of those features, the functionality that is out there. And it's really interesting. So similar to like a MongoDB or Twilio, Elastic took a similar approach of Shai Bannon, who's the founder. I want to say it was 2010 that he created Elasticsearch, which he open sourced the technology, and he grew a pretty strong developer community around it pretty quickly. And as of now, there have been over 350 million downloads surrounding the Elastic stack, which includes Elasticsearch and all the different functionality that Elastic has, which is pretty striking. And right now they have 5,500 customers, and these are, a lot of the big names that I mentioned to you. And as you can see, they're growing incredibly quickly. So over the past year, they've grown their customers about 80%. And perhaps just as impressive, their net expansion rate is 140%, which means that, Facebook takes them as a customer the next year, they're doing 40% more business with them. That across the board adds up really quickly. Of course, these numbers will go down, but the opportunity to scale this up is pretty tremendous. Unfortunately, everybody who looks at Elastic seems to see that too. So the valuation is pretty high as well. I'm sure this has fallen a decent amount again since we put these slides together. At this time, it was trading at about 25 times sales, which is super steep. It's probably around 20% right now. The company is unprofitable, so they have a lot of work to do. But what they're doing, the technology and their ability to get these high valued big clients and to scale with them, I think it's incredibly exciting. Shai Bannon, he continues to own 12%, I believe, of the company, so he's here to stay, I think.
Awesome. Thanks, Aaron. So I think that brings us to Q&A. We have roughly 10 minutes, so that's perfect. A lot of questions, and of course, if you have questions, go ahead and use the app. I'm going to do my best to try to take a quick look at them and see if we can answer them. But first, a general question, Aaron, you can start and I'll answer as well. But what IPO are you most excited about in the coming months or 2019?
Oh, that's a good question. Maybe Lyft. Maybe. So Uber, they're talking about targeting a $120 billion valuation. And I mean, the business is interesting because it is cars right now, but they're trying to create transportation as a service for lots of other things as well. Uber owns, other ride-sharing, parts of other ride-sharing companies in other countries when it cut deals over the past couple of years. But Lyft, I think their last valuation was around 15 billion. So if you're looking at comparing the two, there might be more valuation upside in Lyft. I know Lyft has continued to take market share over the past year or two, just as a lot of drama has fallen onto Uber. So yeah, I'm really interested to see what those two companies look like once they file, but Lyft seems maybe more interesting to me.
I have to say Airbnb for me, because as an Airbnb host over the last bunch of years, I have a pretty intimate knowledge of how they work and just how much money they make, and it's obscene. Are there any Airbnb hosts in here who have hosted? Oh, okay, a few. So as an Airbnb host, you set a daily rental rate, obviously, for your property, the unit or the house, and Airbnb charges your guest, anywhere from 8 to 12%. That's what they take from the guest. That's the biggest share. And then, but from you, they take a 3%, transaction fee. So in other words, Airbnb has both sides, and of course, it's a beautiful business model, and the network advantage they have is huge, but it's really such high margin profit. They're essentially creating the network, the platform, and users like me, hosts like me and guests, we do 99% of the work. and Airbnb takes a incredibly healthy cut of that. And so it's a tremendous business. The thing with them and with Airbnb, and I've even seen it in my hometown of DC, is a lot of cities, municipalities are kind of clamping down on some of the abuses. Some of the hosts that have kind of gone a little overboard with the amount of rental units they have. It's kind of lost a little bit of the personal factor, the sharing economy that Airbnb is kind of spirited towards. And so that has an opportunity to really shrink the potential market opportunity for the business. But I still think it's an incredibly successful company, and I'm very excited to see them go public.
Here's a good question for both of us. Of the 6 IPOs presented, which 2 would you invest in now? You want to take one? I could take one.
Yeah, let's do that.
All right.
And I'll just say the one I've already invested in is DocuSign. I love the platform, the network effects, the brand recognition of the business, the recurring revenue, very low capital cost of the business. It's not without competition, and it's again, whether or not it remains the leading e-signature solution, very much up to question, but is the one that I've really glommed onto. So.
Yeah, and I'll just add to DocuSign, I'm starting to look at it pretty seriously as a potential crypto society recommendation. We'll see, but it's interesting what they're doing, because if you think about just the idea of signatures and identity, that lends itself pretty well to crypto. And DocuSign has rolled out a blockchain solution internally, which hasn't gained much traction because, it just isn't right now. But they also have recently rolled out in the past quarter the ability for signatures in these documents to be minted securely to the Ethereum blockchain, which is a pretty fascinating solution. And if you're playing this industry for 10 years or so, it makes a lot of sense that a lot of how signatures and contracts work will shift over to smart contracts in crypto. So it's good to see them ahead of the game there. Who knows how that'll really shape up, but fun fact. The company I would probably go with right now is Zuora. The tailwind just seems super obvious to me. The subscription economy is not going away anytime soon, and it's probably going to be picking up for many more years. And Zuora is, a leading contender to continue to get like the biggest and best companies as well as the startups, because there really are both of those angles to it. For new companies coming up, if Zuora is building the brand, this is where those subscription companies will turn to first. And for companies that are looking to pivot and modernize their business models, and Zuora will also be who they turn to first. Plus the numbers are good. And I've been really impressed with their ability to scale their products. So I'm really interested in Zuora.
This is a more general question. I like it. When is the best time to invest in an IPO? We can both take a crack at that.
Yeah. So I would say probably biggest picture wise, probably after the first year or so, because statistically as a whole group, IPOs tend to underperform in the first year. Just because there's so much hype when they come out, and then it tends to fizzle away a little bit. On average, that makes most sense. And it also gives investors a good opportunity to start, you get to see quarterly performance rollout. You can see if these companies will perform as well as they say they will in their prospectus. But there are so many great companies and great examples that you could tell from the very beginning, just based on their growth, based on their profitability right out of the gate, like Google, for example, or MasterCard, that on day one, that was a pretty great time to be buying.
Yeah, I agree with Aaron on the first point we made, which is kind of waiting a year. And I think if I might be recalling incorrectly, but I think David Gardner at some point has come out and said he likes to see how an IPO does over the first 12 months. Looking back, in its first year, did it outperform the market? And that can be kind of an interesting clue as to how the company's executing and how the market feels about the company. Unfortunately, I've broken that rule twice this year, because I bought IGE when it came public at the end of March. I bought it on its first day in the market, and then I bought, as I mentioned, I bought DocuSign a little while ago too. And that's mainly because I had taken the time to really get to know those businesses, reading the S1 and getting familiar with the companies, and of course the brand recognition. And so I felt okay going in. But again, in that first year, I think it's worth waiting, especially because obviously a lot of these IPOs have lockup periods as well, where insiders and executives have to wait. Usually it's 6 months after the IPO when they're selling. There's usually some kind of artificial pressure on the stock anyway. So patience can be rewarded with IPOs. Yeah,
and a fun peek behind the curtain, just because we were both on the Rule Breakers team and have interacted with David Gardner about recent IPOs and such. He has a great analogy that he uses I remember I don't remember the company, but I brought up a recent IPO, and the first quarter was not very good. And he said, they great wolfed. And I was like, what do you mean they great wolfed? Well, apparently the Great Wolf Lodge was an early rule breakers recommendation. And I went and looked at it, and it was one of the very few times that it was recommended straight out of the IPO. They had a bad quarter. David sold it like immediately. So that kind of burned in my mind. It's like, yeah, maybe we should watch the first quarter, see how it does. Because a lot of times it does not live up to the hype that was built in the prospectus.
So we're almost out of time, and I know there were some questions we didn't get to. So please definitely, there we go.
Yes.
David G.
Thank you. I just want to fill out the Great Wolf story really quickly. And I see it's like 30 seconds. But I still want one more question. So all I want to say is thank you, Aaron. That is exactly right. And the main point, this was learned from Howard Schultz. Howard Schultz is the founder of Starbucks, and his firm was an early investor in our company. And so we got to hang and learn from Howard in some of our early days. And one of the things he said was he ultimately wanted the Motley Fool to go public. And so he was saying, guys, so the biggest thing for going public is you need to know your next 4 quarters out of the gate. You have to have your business to a point where it's mature enough that you have it locked down. Howard is an intense guy, so this sounds intense. I don't even know if it's true, but this is what he said. He basically said, when you go public, that is your big moment. And so you need to make sure that Wall Street gets behind you. If you fail them coming out, they will walk away forever from your company. And so Howard had this intensity around the idea of going public that you really have to have your business at a predictable state, which, by the way, I don't think we've ever had. I mean, maybe we're there now, although I don't think we're going public. Talk to Tom if you're interested. But it was Great Wolf. I recommend it. I liked it. And right away, their first quarter, they're like, oops, no, sorry. We've surprised. It's disappointment. And that, to me, said that company was just kind of going public to go public. They really didn't have it together. And so it was a quick trigger to exit it, which we very rarely do, as you know, if you follow Rule Breakers or Stock Advisor or really the Motley Fool. And of course you do because you're here. So that's the story. It's ultimately the reason I wanted to come grab the mic was to thank Aaron for knowing that reference. And then to make sure that you knew that it was that conversation with Howard Schultz and what he inculcated on me at a younger age about how, so anytime I see an IPO come out and in the first 1 or 2 quarters, they've blown it, then I'm thinking they didn't go public for the right reasons, probably. It's unfair. I'm sure there are exceptions, but that's it. Okay, sorry. Back.
Thank you, David.
Thank you.
Well, that's the show. It's edited officially by Rick Engdahl. Hey, let's have a disclaimer. As always, the Motley Fool may have recommendations for or against the stocks we talked about on the show. Don't buy and sell stocks based solely on what you hear here. Our email is answers@fool.com. Join our Motley Fool podcast Facebook group or follow us on Twitter. Or you can also leave us a review. But most importantly, stay foolish, everybody.